most people don't use the equity that's in their current home to add to their asset list. So I'm going to give you an example here as we're talking about it. And I'm just going to use $100,000 value of a home. As a matter of fact, what I'll do is I will use some money because it's a great... Well, here's $100, $250s. Would have been better if it was a $100 bill. Huh? I already spent that one. Okay, so this is an asset. It's $100. We're going to take it as $100 or $100,000 value of something.
Okay.
We'll call that real estate. All right. So the reason that this is important is because we can assign a value to exactly this. You agree and I agree that it's $100 worth. If it's $100,000 or $10,000, whatever. Now, as the property value increases, this property value, this is really property. Mm-hmm. You know, whoever holds it has it. So if the value of the property increases over time, now it's worth $200. We've created $100 then in equity, but it's what I call dead equity. It's not doing anything. It doesn't earn anything. The debt equity that's inside of people's homes is sitting there, but it's like all of these little George Washingtons that are not out there earning. You just told me, we were talking about stocks. You said, I like to buy the stocks because over time they go up and they throw off a return. That's what they do. They throw off a return.
The dividends.
Maybe. Yeah, dividends. Increase in its value, like equity growth. Mm-hmm. Okay, that's really what stock, you know, you bought it at 50, now it's worth 100. What is that? That's equity growth. It's no different than a piece of property that you bought at $50 and now it's worth 100. But that equity, you get taxed on when you sell it. The benefit of real estate is that when you have a property, there's a whole industry, a mortgage industry that's out there that's devoted to loaning you money because they want to charge a rate of return. Mm-hmm. Now, in today's market, the interest rate is crazy low. They just lowered it again and they're expected to do it again.
Yep.
Great. But for most people, that really doesn't mean much. It means that the CDs that they have are going to pay less. So when they see interest rates decrease, they know that their CDs and their annuities and different things, those are going to go down too. Yep. And that cuts their income and that hurts them.
Yep.
Okay.
I saw that. I've got a high yield savings account.
Uh-huh.
When I opened it, it was 2.25%, and it was dropped down to 2%.
Uh-huh. And isn't that, so let's just, that's fascinating to me due to the fact that two people can watch television and see that interest rates were cut and have different reactions. I see interest rates cut. I look at equity growth. I look at now at the mortgage rates being less, they can afford more, and it usually will increase the value of real estate.
Right. Because the buyer's buying power has just increased.
It just increased, right? It's cheaper per month and it's a better loan at 3 and whatever percent it is now, 3.5 or something. Mm-hmm. That's like free money in real estate, right? So when interest rates go down, investors look at the market and say, I can borrow against this because rents don't go down because of it. Maybe somewhat they'll be flexible, like new landlords will charge a little less because they're still making a profit. But overall, the rents are set at a bar at whatever is competing with them. Mm-hmm. If rates go down in there, then you're just making a little bit more profit.
Right.
So maybe it sparks a market. That's what they're doing. They're trying to increase it. But others that are sitting in front of the TV, they go, interest rates went down, we're earning less. And if you're in a retirement situation, then now you're going, oh, now we have to tighten our belt because we've just lost whatever it might be.